Stocks climb led by mid-caps following a recovery in the US equities overnight. Industrials and IT are the big gainers while FMCG drags.
Bajaj Auto posts an operating margin of over 20% for yet another quarter and trims its costs in the electric vehicles business, which now commands a 22% share. Exports are also seen perking up in the fourth quarter.
JSW Energy slides on a sharp drop in margins and Bosch sulks on a poor show of its consumer business, but BHEL climbs on strong sales and order inflows, while Suzlon delivers heady growth with stronger margins.
ITC Hotels lists on the bourses at a valuation in line with analyst expectations, but expectations of fund flows due to exclusion from the frontline indices and likely inclusion in the global indices keep the trades skew. Good afternoon, you're with us here on Halftime Report on CNBC-TV18. I'm Hormus Fatakia. With me is Mangalam Malu. As always, we're counting down to a very big event overnight and, of course, a very big event on Saturday. So it's a very event-heavy next few days that are lined up for our own markets. But there is some green on the screen, at least as of now, continuing from where we left off in yesterday's session.
There is good green, 23,100 plus, and it's building on to those gains. The most important thing will be the second half of trade. Typically, the street goes into Fed events long because the street believes that maybe there could be some sort of support coming in from the Fed itself. But be that as it may, tomorrow is the expiry and thereafter we have the build up to the budget taking place as well. And today is also the day where trades for the Feb series open up as well. So those are a couple of factors that we'll keep an eye out on. We're currently at the high point of trade for the Nifty, led by the Nifty Bank, which is doing extremely well. And the broader markets actually are the ones which are outperforming. After the drubbing that we saw in yesterday's trading session, the mid-cap index up nearly 2%, the small-cap index even better as well. But let's get talking about earnings. Kabel is the first management of the show. The company reported a mixed set of third-quarter earnings, pretty much in line with what some of the other peers have reported as well, where the growth was led by the non-cable business. And in cables and wires, of course, there was moderation in demand, and at the same time, there was a decline in prices of the underlying metal itself. Let's discuss this and more. We have Rajesh Jain, who's the CFO at Kabel, joining us. Thanks a lot, Mr. Jain, for joining in. I'm looking at your performance, comparing it to the other peers as well. Just wanted a couple of details. One, what is your prognosis for volume growth in the cables and wires business in this quarter and going forward? And secondly, where does your market share stand at right now? Because I see Polycab having done a little better than you in terms of reported growth, and Havells having done a little less than what you've done on a reported growth itself. Would that be a way to look at this performance and deduce that maybe you gained a little market share but lost some from Polycab as well?
So, good afternoon, first of all, and thanks for calling us. If we see this quarter performance and even at YTD levels, like we have grown around 12%, and in that also particularly in wire and cable, it is growth at YTD level is 10%, and in my FMG business, it is around 25%. And when we talk about market share, see, this is not that much a very big change that it may have a huge impact in market share. It may be hardly maybe 10 or 20 bips here or there. So it is not directly measurable. But within wire and cable, of course, we have seen a very good growth in our cable division, where still we have like very good focus for future growth also.
Mr. Jain, good afternoon. Thank you for joining in. I wanted to talk to you about the business mix overall as well as on the segmental basis. Your exports were around about 27% this quarter. How has the export demand looked like this time around? What are you witnessing currently? And I ask this to you in particular, considering the volatility in commodity prices that you're witnessing. What are the on-ground trends that you're witnessing right now when it comes to demand, both on the export front and on the domestic front as well?
Yeah. So first of all, like we are the largest exporters of wire and cable from India, and it is almost contributing 27-28% in our overall revenue. First, if you see overall, like 88% of our revenue is coming from wire and cable, and 12-13% is coming from FMEG business. Within wire and cable also, we have seen a very good demand from export also. Though in first half of this year, there were like some disturbance and we have seen some impact in our demand also. But going forward, it seems we have very good demand, even looking to the international scenario, growth or additional demand from Europe, USA, and all other countries. So it seems in future also we will see good growth in export, particularly in cable business. Same way, even in India also, right now we are like a wire heavy company where most of our revenue, almost 70% is coming from wire within wire and cable. So now slowly we are increasing our capacity in cable also, and cable particularly it is going at a higher pace when we compare with wire.
All right. Can you give us a sense of two numbers? Just first one is that in the third quarter, your volume growth in the CNW business on the whole was slightly muted at around 2.5%. For the entire year, you had guided for about 20% growth in the volumes. Do you maintain that number? And secondly, for the annual, projections as well, the first 9 months, your revenues have been close to around 12% higher as against the same time last 9 months. What is your prognosis for the end of this year? Where do you think that revenue number would be?
Yeah, so this year, of course, we could not achieve what we had planned at the beginning of the year, but at least in Q4, it seems our volume growth will be in the range of 15%. And so since we had a lesser growth in the first 9 months, so at overall annually basis, our growth may be a little bit lower. But going forward, it seems again, since like international markets and even domestic, we are building our capacity in cable where earlier we were short of supply. So now we see a good growth in the range of 15% for our wire and cable business.
Can you put a number to that as well, Mr. Jain? Since you mentioned growth will be lower, how much lower does that translate into your top line as well?
So top line right now we are 12%. So of course it will be in the range of 14 to 15% on annualized basis.
Okay, 14 to 15% on top line growth, and 15% is the volume growth, which you've actually curtailed from earlier guidance of 20% itself. Let's talk about the margins then, because we've seen some margin improvement in your business as against the others, which actually showed some sort of margin decline as well. You were targeting double-digit margin in this business. By when do you reach there?
So earlier we had predicted that by FY27 we could achieve that double-digit margins. But it seems since this year we missed that track, so now we are planning that we'll get this double-digit margins by FY28.
And FY25 and FY26, what are your expected margins? Because earlier you had expected 100 to 125 basis points improvement in margins in this financial year.
So, like last time also we told that since we missed very heavily in our first half of this year, so this year it is not possible even to achieve last year margins rate. But going forward, again, we are on track and we have planned to have margin improvement of 100 to 120 bips on year basis from next year onwards.
Mr. Jain, two-part question on the FMEG business. You had first mentioned that you will break even on the FMEG business once you reach around about 1100 crores of top line. You are currently at around 667 for the first 9 months. Does that happen by the end of the year? Part one. And part two is you mentioned around 12 to 13% revenue share from the FMEG business. Does that move higher as we go into FY26?
Yeah, so since we are expecting that our FMEG business will grow by around 20 to 25%, and at the same time, since wire and cable is also increasing, so this share may from 12 to 13%, it may move to 15%, 16% by the end of next year or by FY27 also. But like on profitability, of course, what we have planned by next quarter of FY26, first quarter of FY26, we may be green at EBITDA level. And it seems we are on track. As you can see, our revenue is growing at 25%. Even this year, we have seen margin improvement of 370 bips, which is like one of the best in the industry. So we are on track as per our plan.
And EBITDA break-even happens in the first quarter of FY26. By the end of FY26, how does that number ramp up? Because this is a business, while it is revenue accretive, it is margin dilutive as well, even though the total addressable market is a lot higher in this one. Could you give us a sense of when does it, come up to the margins that you're doing in CNW business already, and when does it become margin accretive and perhaps EPS accretive as well?
So it will be too early to predict normalized EBITDA percentage of 8 to 10%. But as per our plan, it seems by FY28 also, there we can achieve a top line of 2,000 to 2,005 crores and can achieve margins of 8 to 9% kind of EBITDA levels in FMG business also.
Very quickly, Mr. Jain, any capex plans that are lined up for the next year?
Yes, we have made one capex plan of 1,200 crores, which will be spread over next 3 years. And this will be particularly focused on our cable growth and as well as some balancing in wire demand also, wire capex
And
also.
that typically yields how much revenue? What is the asset turnover on a business like yours?
For this phase of our expansion, we may achieve a top line of 4,000 crore on investment of 1,200 crores.
All right,
All
we'll take
right,
that
Mr.
point.
Jain, thank you so much for sparing time and joining us. Wish you good luck for the rest of the year and for your expansion plans as well. The management of RR Kabel cutting its revenue growth guidance, but has earmarked a capex plan for which it expects a top line of around 4,000 crore rupees. Time for a short break. Up next, we connect with Dheeraj Singh, who's the CEO at SIS, to discuss the quarter gone by and the road ahead. Stay tuned. Welcome back. Continuing with corporate conversations then, SIS is the next management. The stock's buzzing in trade today. The company reported a good third quarter result. Dheeraj Singh, who is the CEO at SIS, is joining us on the show now to discuss the quarter gone by and the road ahead for the company. Mr. Singh, good afternoon. Thank you for joining in. In the first 9 months, your top line was around 7%. You ended FY24 at 8.1. What do you end the year with? A, do you expect to see double-digit growth by this year, or double-digit growth by FY26?
We've had a CAGR of about 15% for the past 32 quarters, if you see that, right, on revenue as well as EBITDA. And we maintain a similar guidance, but typically we are about 2x of GDP growth has been, and we expect this year to be around that 12%, so it will be in double digits. And going forward also, we would like to maintain similar growth organically, but what would add to it is the inorganic part, leading to the 15 to 16% growth on an average.
Let's talk about that then. Inorganic part is what you've whetted our appetite for. What is it that you're looking at, and what segment? Is it India security? Is it facility management? Is it the international security business? What size? We have a rough idea of it should be incremental of 3% of your revenues, because if you're doing 12% organically and 3% additionally, we have a rough revenue estimate of this. But what are you likely to pay for it? Are you in touch? Anything we can hear in the very near future?
Sure. So our focus remains on India market. Over the past few years, we've increased our EBITDA percentage from India to more than 2/3. So our focus for M&A also will remain for the India market across all the three segments. So as of now, we have signed term sheets for deals in security, facility management, as well as in our cash logistics business. And in terms of timing, we expect to be able to announce hopefully within the next 1 to 3 months, maybe 1 or 2 deals.
Next 1 to 3 months, expecting to announce 1 to 2 deals. That's interesting. You mentioned that you're going to focus on the Indian markets, but your the security business domestically, that the margins for that business have remained flat, if I could call it that, or constant for over the last 3 to 4 quarters at around 5.5%. What would you attribute to the fact that these margins are not picking up from where they currently are, or do you expect them to remain at these levels going forward as well?
So from the post-COVID period, where we had security business had reached a margin of about 4%, for the next few quarters, it steadily climbed up to 5.5%. Yes, it's been steady there. One of the main reasons is that we are investing a lot in our technology, both internal as well as client-facing. One of our business is in the residential alarms business, we protect, which is a very high value generator for the future. But like any B2C business, it requires more investment upfront. And that is something that is keeping the margin at the same level for security business as of now.
How much more do you expect to continue investing, and for how long do these margins remain at these levels before they start picking up?
The security business will pick up from the 5.5 to about 6% within the next 2 to 3 quarters. But our focus now has been more on the facility management business, which had been struggling on the margin front, as you're aware, for the past several quarters. The good news out there is now steadily increasing. We are given the guidance it'll be increasing about 0.25% every quarter. And I'm happy to share that it's increased from 4.3% to 4.6%. And I can see confidently this trend continuing for the future.
Closer to 5% by the end of next quarter, and thereafter this quarterly improvement of 25 basis points continues. Just a word on these deals itself. If you could give us a sense of the current cash on your books, roughly what size could these acquisitions be in terms of an outflow from your balance sheet, and are you looking to raise any debt to fund these acquisitions? Because your net debt to EBITDA came down from around 1.5 to closer to 1. So the street is keeping an eye out on that ratio as well. If you could give us a sense on all of this.
We've always maintained that a comfortable ratio, net debt to EBITDA, is about 1.75 to 2 in this industry. Globally also we've seen that. But we've managed our working capital very efficiently. We've reduced our net debt by almost 230 crores. Our DSO, if you look, has reduced from almost 74 days similar time last year to now about 69 days. So we are doing all the efficient working capital management, but you're right, as and when the M&A cash flow investment arises, we will look at altering our debt. But typically the deals that we do, they are in the range of 51% upfront that we buy. So it is not an immediate cash flow, it is staggered over 2 or 3 years' time.
So would you be raising only debt to fund these acquisitions, or is there an equity fundraise also in the pipeline?
Not at these current prices, but we are always open to that in the future.
And what about the potential size of these acquisitions? I mean, we understand that you'll be paying 51% upfront, but typically what size do you acquire companies at?
So our M&A process is very, very defined. We look at anything not less than an IRR of 25% on the deal. It has to be a geographical fit or bringing certain niche skills to the group. Now, given these criteria, we might look at anything in the range of about 60-70 crores top line to 1,000 crores. And as of now, we are looking at the deals that are in these actual ranges. But a lower size deal would typically have a higher EBITDA percentage. So it'll be good for EBITDA accretive for the whole segment. And the larger size deals will, of course, add to the operating leverage. And so that is our approach, yes.
You've done a phenomenal job of, actually not answering what we wanted to get out of you in terms of an outflow from your own books. Yes, you've given us the entire range, 60, 70 crore to 1,000 crore in terms of a size. That's the big buffet. But, from how much will you pay for something like this is what we're trying to understand. Do you pay 2x sales, 3x sales, 4x sales? And if you could give us a rough range of the money that will be going out of your books because of this, it'll give us a sense of, how much you're looking to raise your debt by.
Sure. Typically, the deals that happen in this space are 7 to 8x of EBITDA, right? So that is one clear metric that will help you understand. If you ask for the kitty, we are keeping ourselves ready for about 100 to 200 crores outgo for the current requirements.
All right, Mr. Singh, thank you so much for joining in today. Wish you good luck for your potential acquisitions as well as for the road ahead as well. Time for a short break. But before we do that, there's some good news for our viewers. India's business news leader is now just a click away, introducing the all-new CNBC-TV18 app, where you get instant access to breaking news, in-depth articles and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or you can scan the QR code as Mangalam just did, and the app is already on his mobile phone screen. Take a short break. He'll be right back.
Well, the market is doing extremely well. We have Reliance, which has moved to the high point of trade, and that's powered the Nifty ahead as well, comfortably above that 23,100 mark for the frontline index. Though we'll keep an eye out on whether this sustains or not. The reason why I say that is because tomorrow is expiry, so good time to get in an F&O perspective on the market as well. There's good recovery, both of the Nifty as well as the Nifty Bank doing extremely well. The Nifty Bank underperforming as against yesterday, where it was outperforming, but the fact that it's holding on to gains of almost 0.5% is supporting the frontline index. The mid-cap index also doing its bit by rallying about 2% odd. For the Nifty, the range is fairly defined. You have the 23,000 put, which is fairly active, 105 rupees on premium, which is telling you that close to around 22,900 would be the first support that comes in were we to fall from here. On the way up, however, 23,100 call as well is fairly active. So close to around 150 rupees in terms of premium. So staying above the 23,200 mark is important for further short covering on that call as well. So for the Nifty, the broad range, 22,900 to close to around 23,250 odd itself. For the Nifty Bank, it's meandering around that 49,000 mark, and that's where the fulcrum has been placed. 49,000 call and put have the maximum open interest for a premium of 350 rupees each, or the call and the put, telling you that the street is positioned for 48,650 to 49,350 for the Nifty Bank range itself, and that ties in with the 20-day moving average on the Nifty Bank as well. The 20-day moving average on the Nifty Bank is 49,286. Yesterday, we went very close to the 20-day moving average before declining for the Nifty Bank. That's something we'll keep an eye out on. And if the Nifty does sustain above these levels and see a short covering pop, an excursion towards the 20-day moving average cannot be ruled out. 23,375 is where that mark is. So we'll keep an eye out on both these indices ahead of the expiry tomorrow.
Very interesting levels there. The Nifty is still quite a bit away from that 23,375 mark, but that has been the range from where it has seen resistance, and then it moved lower yet again. So the important levels to track on both the benchmark indices. By the way, just before we take that break, a lot of these beaten down names are making a bit of a comeback in today's session. Netweb Technologies is up 10% after the clarification that they issued on calling DeepSeek an opportunity and not a threat. So that's a 10% circuit there. Anantaraj 2 is up 9%. So good going for both of these names. Credit Access Grameen is up 9%. That stock is also being battered out of shape. And Keynes Technologies, after the drubbing it took yesterday, is up 8% after the upgrade that it received post its results. So good going for a lot of these beaten down names. Take a short break. On the other side, we connect with Nikhil Dhingra, who's the CEO at Acme Solar Holdings, to discuss the road ahead for the company after the Q3 results. Stay tuned. Welcome back. Watch us on a halftime report. Continuing with corporate conversations, then Acme Solar Holdings is the next management. The stock surging in trade today. The company reported a good third quarter performance, and you can see the stock is locked in a 10% upper circuit. To discuss this and more, we are joined by Nikhil Dhingra, who is the CEO at Acme Solar Holdings. Nikhil, good afternoon. Thank you for joining in. I'll start off with your capacity. What's the total tied up capacity that you're expecting by the end of the financial year, this and the next financial year as well? If you could share some numbers on that front.
Sure. Thanks a lot. So we have a current capacity of 2540 megawatts, which is currently operational, selling power on a 25-year PPAs. So this capacity is expected to go up by 350 megawatts in the upcoming quarter or the quarter after next. So this will take us to around 2900 megawatt, and then a 100 megawatt plant is expected to come up after that in the quarter after that. So 3000 megawatt. And of course, other than that, we have around 4,400 megawatts of under construction projects, which will be coming up in the next 2 to 3 years. 27-28 is the timeline for that. So we will be targeting to reach 7 gigawatt, which is our contracted capacity by 2027 and 2028. And this ramp up will be starting from June 26 onwards. Each of these plants will be coming up. 4,400 megawatt will be split from June 26 onwards, going till December 28.
You've given us a projected, EBITDA run rate at anywhere between 1,750 to 1,800 crores in the presentation. Just wanted to know, with the ramp up in capacity, what is the steady state EBITDA run rate that we should be working with? And this largely because of one of the deals that recently happened. You got a 250 megawatt FDRE project from NHPC at a tariff of nearly 4.56 rupees per unit. Analysts are actually assuming 50% higher EBITDA from current levels from this project. Is that assumption accurate? Could you give us a sense of how one should look at your EBITDA from here on, and throw some light on this one as well?
Sure. So we commissioned 1.2 gigawatts of capacity in this quarter, right? So the EBITDA we are guiding on is the operational capacity, which is already operational and logged in with the PPAs and already selling power. So this EBITDA we are saying is because of the operational projects, which take typically 2 years to build. So this 1750 is from already operational assets. As we add projects, like I guided, like in next 2 quarters, we are going to add 450 megawatts of capacity next 2 to 3 quarters. So that will take this EBITDA to upwards of 2100, 2200 crores range. This is the operational EBITDA I'm talking about. So what we want to guide on is the operational EBITDA numbers, where once the asset gets operational. So accordingly, we have guided on from the 2.5 gigawatt we have, we will generate 1750 to 1800 crores of EBITDA. In terms of the bid you spoke about, that is the bid we have just won in the last quarter or so. So that will take some time to get into our revenues. And of course, that will get into our revenues maybe in 2 years' time, because 2 years' time is the time at least it takes from bid to operational date. And in terms of the EBITDA margins from those projects, so in a solar or any renewable, the EBITDA margins at a project level are typically 90%. And they remain around that because there is no fuel expense, like we mentioned earlier also. So in terms of the EBITDA margin, 90% is there. But in terms of the revenue itself, the CUF is higher because you are supplying peak power. So you get as closer to thermal as you can by supplying a CUF of around 55 to 65%, depending on the configuration you're choosing. So on a per megawatt of contracted capacity, the revenue is higher by the number you mentioned. Typically, they will do in a solar plant, you do a CUF around 30% on the peak basis. Here you're doing 55%. So revenue per megawatt of contracted capacity is essentially double. So that's how it works on the FDRE side.
So if we do just rough math, right now you have about 2.5 gigawatts capacity. You are targeting 7 gigawatts by in the next 2 years, along with some of the orders that you won, etc. Your current EBITDA run rate is close to around 1800 crore basis the operational capacity. Multiply that by 2.5 times, given your capacity increase as well. Do we expect your EBITDA to, touch that 4,500 crore mark by FY28, FY29? Would that be a fair assumption? Could it exceed that, given, these orders that you win as well? Should one work with a number closer to 5,000 crores?
Yeah, so it will see in terms of the numbers, like I said, the revenue is to divide, you can say 55 by 33 is the revenue in terms of the units. And of course, the tariff is also higher. So it will be higher than what you said. It will be substantially higher than what you said, simply because the tariffs are also, let's say, 2.5 to 2.8 is the solar tariff. In an FDRE, it is 4.5 rupees. And the CUF is also around 2 times. So it will be substantially higher than that, the number you mentioned, once we commission the 7 gigawatts. And that, of course, can be estimated by any analyst basis the tariff which is available and the targeted CUF which is also available.
Not every viewer is an analyst. So if you could help us, understand how much does that mean when it comes to substantially higher? Are we looking at numbers closer to $1 billion then?
See, right now we are not giving any guidance on that. So it will be, what I can say, it will be much higher than 4,000 crores, which you mentioned that. We are not giving any guidance on the numbers. But since our business is very predictable, that once we operationalize, then I am able to give you a guidance, because then I can say that I'm generating this much power. For me to comment on a future number, it will not be possible today in terms of the 2027-28 numbers. I think it will be best done by analysts basis the PPAs we have and tariffs we have.
Nikhil, one final question, and if you could quickly tell us, you spoke of adding capacity. How much are you going to spend on that? And if that is so, how does that impact your debt picture? What's the current debt? And if you plan on bringing it down, how will that impact your financial performance in terms of bottom line margins and so on?
Right, right. So, see, in terms of the debt, we have mentioned that we will always be under 5.5 times debt to EBITDA, right? Because EBITDA is what helps you to repay that debt and what helps you to generate the free cash flow to equity. So right now we are very much under that 5.5 times on a debt to EBITDA basis. Our debt has, of course, we have paid down a lot of debt in this quarter of around 2,100 crores. Because we raised money of 2,400 crores. So all of it has been used for repaying debt, the primary capital. So right now we are at this level, which is debt to EBITDA very comfortable. So when we build a project, typically we take 75% of money as debt and 25% we have to invest. And this debt is long-term debt because our PPAs are for 25 years. The contract for sale of power is 25 years. So you get a debt closer to 18 to 20 years of repayment cycle. So 5.5 is the level we are quite comfortable with. And each of our project is designed to service this debt at a much under that 5.5 types of all of our capex, all of our financial planning is done with assuming that we will never cross that 5.5 times debt to EBITDA number.
Right. Even if you do, a little over 4,000 crores, as I said, substantially much over that 4,000 crores, I said, your debt would peak out at close to around 25 to 30,000 odd crores as well when we speak about 7 gigawatts. Just a final quick question on each of your capacity. What is the typical payback period?
Yeah, so see, in terms of that's a very important thing for a utility like us, renewable utility like us more so because we win our projects in the bids. So very important for us to be capital efficient in terms of the return on capital employed. I think we have mentioned in our presentation also on a pre-tax basis, we do 14.5%. So if you just look at that, it's around 6 to 7 years on a capital invested on the equity basis, the returns are slightly higher. So 6 to 7 years on a capital employed basis.
Right. All right, Nikhil, thank you so much for sparing time and joining us today. Wish you good luck for the road ahead. The management of Acme Solar, the stock locked in a 10% upper circuit. Take a short break as we count down to the budget. On the other side, we get you the key expectations of the defense sector from Finance Minister on Saturday. Stay tuned. Back on the other side. Welcome back on to key expectations from the union budget from the defense sector. Upasana is joining in with more on that. Upasana.
Well, this time around, we're expecting the focus to remain on the core capex sectors like railway, roads and defense. Mind you, defense substantially lagged in FY25. Of the overall capex, Elara expects 55 to 60% of the allocation towards road, railways and defense. And this time we're expecting the higher defense allocation. Now, FY26 budget is to be a growth-oriented with an emphasis on increasing capex spending. Defense is anticipated to be a key focus area, supporting the nation's long-term growth objective. Now, we expect the defense capex budget to rise by 7 to 8%, reaching nearly about 1.9 lakh crores. Defense capex is likely to be dominated by higher allocation for aircraft and engines, naval fleets, and even other equipments. This higher allocation will support indigenization and more defense production. Now, more schemes are likely to boost the defense exports, which is in line with the government's target to reach 500 billion by 2029. On back of this, defense export companies like HAL, BEL, Bharat Dynamics and Solar Industries will be on focus on back of this. Also, we are expecting some changes in the scheme to attract more startups and technological advancements which will support companies like Zentech and IdeaForge. So overall, we are expecting a higher budget allocation for defense this time around.
Keep an eye out on that, Upasana. Thank you for that earnings expectations. By the way, pull up KPIT Tech, and that has seen a very, very sharp surge after its results announcement. There you can see 6.5% higher now on KPIT Tech, and that's because of the flash on your screen. The company has increased its FY25 margin guidance to 21% from the 21% plus, in fact, from the 20.5% plus earlier. And the constant currency revenue growth guidance has been maintained in the 18 to 22% range. The US dollar revenue as well increasing 2% on a sequential basis, up 18% year on year. But the big takeaway on the KPIT Tech result is that they have increased their margin guidance for FY25 to now over 21%. The stock seeing gains of up to 5%. Take a short break. On the other side, Manisha Gupta joins in with Ishu Datwani, who is the founder of Anmol Jewelers. Stay tuned. We'll be right back. KPIT Tech is the stock of the last 10 minutes, now 7% higher after the company increased its FY25 margin guidance, and it is continuing to build on to those gains. 7.5% higher now on the stock is KPIT Tech. Has been an underperformer over the last 1 month, but now the management increasing its guidance, and you can see that in the stock price. But over to Manisha Gupta now for our commodity corner.
Well, there's so much uncertainty in the global markets, and there's one thing that really seems to be reigning in all that safe haven and hedge buying, and that is really gold. If you look at the international markets, well, we are not too far away from its all-time highs. The all-time high that the gold prices hit in 2024 was at $27.90 an ounce. We were trading at around $27.60 plus kind of levels in the international markets, so not just about $30 away from all-time highs. And when you look at the Indian markets, well, that's an all-time high for the gold prices for India that you can see on your screens. Ishu Datwani is founder of Anmol Jewelers, and he joins us on phone line now. Ishu, hi. All-time highs for gold, and we do understand that when it comes to gold buying in the Indian markets, it's not too high. There's a bit of a pause. Gold is selling at discount in various states of India at this point in time. Your reaction, first of all, to the gold prices. Where do you see prices headed?
So, a statement that Mr. Trump made where he said, we are going to reduce our interest rates. And he also appealed to other countries and other banks to reduce rates. And I think this is the reaction for that. Usually when we see prices rising, there's always, after a point, there is always a correction and prices do go down. But this is one rally that we've seen which is unrelented, and we, and I'm sure all other jewelers in the country, probably hedge every evening. So every evening, whatever gold we've sold on that day, we will buy that much gold, because this is almost like a one-way street. We are not seeing any reduction in prices. So even now, in spite of all the, rallies that have happened, we still expect gold to go up even more. So not taking any chances. And similarly, even the sentiment that the buyers are sharing is similar. They are all very bullish on gold and expect gold prices to go up, which is why even in terms of business, we are not seeing a drop in business, because the expectation is that if we don't buy now, we will lose out. And with the wedding season being the way it is, there are so many weddings, gold is still pretty good, and we are doing very well with gold, in fact.
All right, that's good to know. Absolutely, safe haven buying just about continue. But Ishu, is there a lot of discounts being offered? Because we do understand that before budget, depending on which way the import duty goes or if it's not changed at all, we do understand that there's a lot of gold available. Is it a buyer's market right now?
I would, maybe for the dealers, for us, a wee bit of discounting is there. But as far as the consumer is concerned, there is no, discount really happening. Well, there are people who always try to lure customers with discounts on labor and, things like that. We are not one of those. But as far as the consumer is concerned, I don't think there is too much of a discount going on, other than players who always, have that strategy of pulling in clients with lower rates and lower discounts, you see.
But are there discounts on bullion, not so much as jewelry for the retail consumer?
Yes, there are discounts. Yeah, there are discounts coming in bullion. There are discounts, yes.
And to what extent really? Because the last I was reading was $50 as well as what we saw in the previous week, which perhaps is the highest in 6 months between bullion dealers. Is it still reading at those levels?
I would say around $30, $35 now.
What is also your sense on prices? We're almost at around $27.50 an ounce, not too far away from all-time highs in the global markets. Is there a sense that you could be looking at higher prices in this quarter, in the first half of this year?
Yes, definitely. We are still bullish because of Trump coming in, and with all the uncertainties that are there, gold is the safest bet. So we are still betting on gold going up even further. And, you know, in India especially, all the more because even the rupee is not so strong. It's depreciating against the dollar. So the expectation is prices should go up even further.
That point is well taken. Mr. Datwani, thank you so much for joining in. Well, that's the point I wanted to put forth, that all-time high gold prices in the Indian market have led to a bit of a discount coming in, and perhaps not to the retail consumer, but as Mr. Datwani pointed out, that between the bullion dealers, $30 an ounce of a discount is what is reigning in right now. This could be ahead of budget. This also could be ahead of the fact that we're looking at all-time high prices and not too many buyers out there. But that's all the time that we have on Halftime Report. Business Lunch will take all the action ahead.